Hello, everyone. Thank you for joining us today. I'm Rita Garwood, Editor-in-Chief of Monitor. On behalf of the whole Monitor team, we're excited to welcome you to our webinar today in partnership with FIS. It's entitled From Asset to Intelligence, How AI is Reshaping Equipment Finance. We have a great panel of experts with us today. Steve Cellini is Director of Partner Development at Microsoft. Charles Ewan is Product Manager, Asset Finance at FIS. Jeff Boots is Solutions Specialist, Asset Finance at FIS. And before we get started with the panel, I just want to quickly go over our housekeeping items. The panel is open to questions today. If you do want to submit a question, there is a Q&A box on your Zoom screen. Just tap that and enter your question at any time, and they will get to it as soon as they are able to. We will be having some polls during the event, so keep your eyes open for those. And with that, I will hand it over to you, Jeff.
All right. Thanks, Rita. Can you hear me okay? I think so. All right. Welcome to this webinar. Sorry about that. Again, from asset to intelligence, how AI is reshaping equipment finance. So thanks to the Monitor for this opportunity. And we look forward to the next 45 minutes or so sharing some ideas with a couple of industry experts in both AI and on the equipment finance side. So quickly, my name is Jeff Boots. I have been in this industry for 25 or so years, different capacities, whether it was working for different software companies, working for consulting firms, consulting to the industry, system selections, those types of things. And I joined FIS about 6 years ago in this role as a solutions engineer. And so look forward to the conversation today, as well as any questions that folks have throughout the day, as Rita just mentioned. So Steve, why don't you give a quick introduction?
Yep. Thanks, Jeff. Hi, everyone. I'm Steve Cellini. I'm a Director of Partner Development at Microsoft, which means that I work with financial services software companies to build products for our joint customers on the Microsoft Cloud. I've been here for 13 or so years and been in the tech industry for over 20.
All right. Charles?
Nice to meet you, everyone. I'm Charles. I am a product manager here at FIS for asset finance specifically. Similar to Jeff, I've spent about 10 or 15 years in the industry working at banks and then actually moving to FIS to do implementation, sales engineering, and now product management. Happy to share some ideas on how we see the industry and some insights on that front.
All right. Thank you, Charles. Okay, so let's get into it here. The first topic we're going to talk about is real measurable value in equipment finance. And I think if we think about our industry, again, I've been around for a number of years where, we had, whether it was fax machines or laminated rate cards, certainly paper-based contracts, limited automation. Yes, we make fun of ourselves in this space as being laggards when perhaps compared to consumer processing, things like that. But I think certainly we've made a lot of strides over the last 5, 10, 15 years, but I think at this stage, right, the pace of change is accelerating so rapidly that the opportunity and quite frankly, the pressure on all of us has never been greater. So no matter where you are in this journey, the speed of change and this opportunity in front of us is just greater than ever. So the first thing we're going to do along those lines is we'll get some audience participation going. So we've got a poll where we want to, there we go. We want to understand, where is your organization seeing the most value from AI today across equipment finance specifically? So we're going to leave that up for a minute or two, and let's start with, let me start more broadly with Steve, from Microsoft, servicing, not just the equipment finance space, but he works in a more broad role across all various sectors, certainly specializing in financial services. But Steve, from your view, right, can you just talk about where you're seeing the real, in terms of shift from pilot to production and where we've been with AI over the last few years, where are you seeing organizations achieving real ROI?
Yeah, over the last 12 to 18 months, we've seen really a clear shift in how organizations are approaching AI. Early on, it was all about pilots or experiments, just proving that the technology worked. We've now firmly moved into production mode. And that's a big deal because production is where the real ROI shows up. The conversation has changed from can we build it to can we scale it? How do we measure the business impact? We're seeing organizations that are embedding AI directly into core workflows, not just isolated proof of concepts. In financial services and lending more specifically, there are three use cases that are consistently standing out for us. One is credit decisioning, where institutions are accelerating decisions, improving risk accuracy. Two would be document ingestion, where they're automating the extraction of complex financial data from structured documents or sometimes unstructured. Third is collections prioritization, where they're focusing resources on the highest recovery opportunities. With production rollouts, though, we must be very clear about how success is measured. The metrics that matter are things like decision time, cost to serve, loss rates. These are real financial outcomes. And at the same time, there's a growing awareness at the CFO level that AI isn't free. As these solutions scale, the costs become usage driven with token based pricing models. And that's bringing a new level of financial discipline, or what you're hearing people call FinOps in terms of AI, where organizations must balance the cost of running AI with the value delivered. So the takeaway, I think, is simple that AI is no longer an experiment. It's becoming part of the operating model.
Yeah. Okay. Thanks, Steve. Yeah. Good insights there. And Charles, from your point of view in the equipment finance space and as a global product manager, where do you see the most value today across the equipment finance lifecycle?
Yeah, absolutely. I think a lot of what Steve said definitely is true. So I think for us, especially around document ingestion, document extraction in the origination process helps a lot with removing the manual input with up to 30 to 60% of reduction in processing costs, and then also times to actually get time to value for the customer, especially to payout and funding. To be honest, for the credit stuff, so the credit decisioning AI bits, it's more of a strategic bet to us at the moment rather than a quick win, I would say. Credit decisioning is historically quite complicated, and also there's a regulatory oversight on it that's going to be introduced with the EU AI Act, which has classed credit as high risk, where you must have human in the loop in order to make sure that there is some sort of human oversight. So kind of from an asset finance industry standpoint, credit is a bit further off, but we're kind of getting to it compared to the banking side. On collections and servicing as well, that's something that is also quite strategic instead of something that we can do right now. We do see a lot of better collection outcomes in cases where it's been done. So proactive collections, where you can see a customer who may go into collections rather than it being reactive after they've gone to collections, which gives companies a lot more opportunity to actually collect those monies back. I think another quick win, however, is automated reporting. So using AI to generate insightful reports, it's extremely easy to run agents nowadays over data warehouses and data lakes. You can talk to your data in unprecedented ways compared to before to analyze trends, behaviors, which are unique to each business. All you need is kind of the idea. And then, as Steve was saying, putting it into production and putting it into utilization, AI will do a lot of the effort and work for you.
All right. So let's take a look at the poll results and let's see if, oh, do I need to, sorry to the moderators, do I need to share those or can everyone see those?
Everyone should be able to see them.
Okay. So what I'm seeing, is, definitely a mix across the different components. Basically a tie between doc ingestion and workflow automation processing across operations. So, okay, not much on the AI chatbots, which is somewhat interesting because I think we've been talking about chatbots in the space for a long time, but probably more something we see in the consumer side than in our commercial equipment finance space. Probably the most interesting to me actually is the credit decisioning and underwriting is still, well, it's a significant portion. So all right, this is interesting. In terms then, so we've seen a little bit of the results of the polls or of this poll from our participants, but in terms of where we talk about scaling, Steve, what do you think is holding organizations back from, scaling AI and actually realizing the returns? And again, maybe a little bit in the context of what you just saw in the poll, but just more
Hmm.
broadly.
Yeah, the biggest challenge that we see today isn't with the models themselves. From a technical standpoint, they're quite capable. It's really everything around them. Data quality consistently coming up as the top blocker, which I think Charles alluded to. We encourage our customers to build a unified data foundation, something like a data lake, combined with an ontology layer that helps identify the key business entities across the systems of record. I know that can be a scary thought. Lots of organizations have tried building data warehouses, data lakes in the past, and have found that that's an expensive and time-consuming process. But the technology in this area, I think, is really advanced to a point where you don't necessarily need to physically move all that data into one lake, but instead you can use technologies like shortcutting, mirroring to make it look like all the data is together, so that you can then create those business entities and those semantic layers on top. Governance and explainability are also very critical, especially in regulated industries like this one. Institutions need to clearly demonstrate how an AI-driven decision was made, and that can slow adoption if those capabilities aren't built in from day one. And this is where modern agent runtimes can start to help by supporting things like traceability, auditability of the AI systems. Another challenge that we hear from our customers is the variability that is inherent to large language models. You may hear this referred to as non-determinism. And we've all seen this in your use of consumer AI tools. You ask the same question twice, you may get two different answers. To make this viable for financial services, customers are putting in guardrails. You have to have models that are grounded in enterprise data and systems. You have to apply the right instructions and skills that can reduce that variation to ensure more consistent, reliable output. And finally, I'd add that change management is a major factor here. In areas like equipment finance, the processes are mature and they're highly structured. So transformation has to happen incrementally. It's not just about introducing AI, it's about thoughtfully redesigning parts of the workflow that make sense for AI, augmenting your teams, and applying the AI systems where it's going to deliver the most value.
Okay. Yeah, thank you. All right. Let's move on then. Great stuff, both Charles and Steve. Let's talk about the next section here we want to cover, which is around speed and risk improvements or risk mitigation, right? And really going to focus on the risk piece of it, because I think we talk a lot about improving speed and efficiency, right? We can have automation in our workflows. We saw that in the answer, and that's definitely. There's no question that's a benefit, but I think one of the things we love to or want to focus on is around risk mitigation, decisioning in equipment finance, and how we can utilize AI and manage see improvements and gains. So, Charles, in terms of in the equipment finance space, right? How is AI helping organizations better manage portfolio risk, and talk a little bit about the real components in the industry driving this?
Yeah, absolutely. I think AI has allowed us to do things that we can't do before, frankly. So when we think about risk in equipment finance, it typically ends up being split into a few areas. The first one being underwriting, right? Credit underwriting, as we've mentioned before. So traditional underwriting takes traditional rules, scores, and then a final judgment. Scorecards are built on limited variables and historical averages, and typically there's a model lag in between an update and a deployment. But AI underwriting moves away from that. So you're moving away from a set scorecard and set variables to data expansion where you've got hundreds to thousands of variables, including things like transaction data, behavioral patterns, and then more market-wide, there's signals, sector signals and asset data. And this sometimes gives a non-linear relationship between these variables, which you can't really detect the way we're doing today. There's also pattern recognition. So there's certain risk patterns outside the model and human observations, which means actually from a loss reduction standpoint, AI-enabled lenders can see probably about 10 to 25% in reduction in loss rates. What that means is you have fewer false positives, so rejecting good deals, and false negatives, which is approving bad deals. Not necessarily changing how your risk appetite is, but making sure you get to the correct deals as you need to. On the other section, which would be arrears and collections. So the modeling being far more proactive can handle volumes and data that teams typically can't, analyzing again transaction behavior, utilization patterns, and payment timing shifts. So you're then using a form of probability-based forecasting. So we've historically done this, but with more inputs, the likelihood similar to credit underwriting is that it's far more accurate. And the result is that we actually see recovery rates decline sharply over time. Earlier action allows financiers a far, far better chance to engage proactively, restructure debt, avoid purely chasing it afterwards as well. And then the final part is typically around asset management and then portfolio risk. So typically, again, this is reviewed bi-weekly, monthly, or quarterly on how your assets are leveraged, how liquidity is. AI allows this to be done in near real time. You have sector risk value variables, up-to-date exposure and concentration risk as inputs. Minor adjustments can be done far more regularly. You can then therefore allow the business to deploy capital more efficiently. You have more exposure to high performing segments, less leakage in the weak ones. And then if you can then adapt that and influence the sales process with it, then sales can also start adapting quickly to the right triggers that you can provide. So there are some really, really good use cases for us. We just need to make sure we can implement it properly from an equipment finance standpoint.
Okay. Yeah. Thanks, Charles. And so, Steve, as I think about what Charles was just saying there, what actually comes to mind is the risk of using AI to manage risk, right? So
Yeah.
building on that theme,
Mhm.
because again, we've historically humans haven't made decisions. Charles talked about regulations where we're saying that, hey, these are areas where humans have to be involved in this decision process. But we think about whether it's underwriting or other components of the overall value chain. And we're making decisions with real consequences. What do firms need to do to deploy AI responsibly, and what should folks be thinking about here?
Yeah, in underwriting, I think responsible deployment starts with governance. It's not just picking a model and going with it and the job's done. Firms need clear accountability, defined policies, strong risk management from day one. And what regulators are often looking for is explainability and transparency. They're very clear in this regard. If you are making a credit decision with AI, you must be able to explain that in plain language. Now, the model decided is not sufficient. Institutions need traceability into how outputs were generated, along with documentation, monitoring, and ongoing validation. And this is where human oversight, or what you often hear referred to as human in the loop, is critical. Maybe you want the AI system to automate a credit decision, but it must always be validated by a human underwriter, for example. The firms that are getting this design right for trust up front are scaling faster and with more confidence.
Okay. Yeah. Good stuff, Charles. Anything you wanted to add, to this before we move to the next topic from
Yeah,
an
I
EF
think
perspective? Yeah.
the key word there is trust, right? Generally speaking. So, how do we ensure this, right? You need to build AI from an audit ready standpoint from day one. So that means having documentation on system architecture. What are the design decisions? How are you handling bias assessments? You then move on to things like traceability, input, output, decisions, audit trails to governance, how you're classifying risk, ownership, cadence. And then finally, from the oversight standpoint, which again is human in the loop, how do you escalate off of that? How do you monitor performance? And then how do you actually detect the bias from what you've documented? I think the main thing is that the EU AI Act typically would likely be the strictest one, similar to GDPR. So that is what most people are focusing on when it comes later on in the year. And then there are processes that they have essentially aligned to. So things which are low risk, which you could do full automation without human review, such as data extraction, report generation, where then you're moving into AI assisted for credit decisioning at medium risk and collection strategies. And then at the absolute front end, you have complex restructuring, big deal approvals, regulatory responses, which have to be human led with high risk AI only supporting.
Okay. All right. Let's move then to our next topic. This is 3 of 4 barriers to entry. So, since it's after lunch on the East Coast, before on the West, wherever you are, let's have another poll to make sure we have folks engaged. All right. So what we want to know, right? What's the biggest barrier of entry preventing you from scaling AI in your organization, or the perceived barrier, whatever the case may be, right? Just looking for some ideas here around where the fear is, right? Because we're going to talk about how folks are managing that in the broader sense across the different sectors with Steve, and then we'll talk a little bit about equipment finance as well. From my perspective, I think a couple of things come to mind as I've navigated through in my role talking to various different folks in the industry. I think number one is a vendor strategy or technology approach, right? So one of the things that you've seen happening is this sort of idea to say, well, we're going to have an agent, or we're going to have AI over on this side of the business. We're going to have a chat bot, or whatever the case may be. And so, but that it's not connected with something else, and there's duplicated effort, or there's worse, there's combative effort in terms of the AI, whether it's the actual technology being chosen or the approach to it, right? So overlapping efforts, inconsistent outcomes, and lack of a unified strategy is certainly one that people don't know where to start sometimes. And so having a strong vendor strategy or approach there from a technology perspective is important. I think it can't go unsaid. This notion of, when you think of a barrier of entry, right? Folks are always thinking, is AI going to take my job? Is AI going to take my job? I think the best quote I've heard that helps me sleep better at night is, AI won't take your job, but someone using AI effectively might, right? So that's a call to action for us to start adapting now and being, in all facets of what we're doing from within our organizations, managing that. So let's move to this next slide here, because I think this is the most important point, right? I talked about vendor strategy, people, and change. This is what we're seeing across the industry, and then I want to compare this to the poll results in a second, right? But McKinsey's done their research here, right? And to answer the question, why is data quality important? Simply put, AI is only as good as the data that's provided as references to make these accurate assessments. And Steve talked about a number of ways to do this, right? But if your AI is not consolidated, it's not in a format that can be read across, utilizing the technology, that is just going to impede your progress in terms of AI adoption and having real measurable results. And then secondly, I think this last number here, right? So approximately 90% of firms have invested in AI, but only less than 40% are seeing measurable gains at this time, right? So it doesn't mean we throw it out, right? But it certainly means we've got to get better at it, and we will as we work, as we learn things and understand. But there are, I think what I want the panelists to talk about in a second is ways that people are maybe bridging this gap from fewer than 40% measurable gains into real measurable results. So let's take a look at the poll results quickly. Yeah, so fragmented data quality. Again, it's a bit of a mix, but certainly, legacy systems and fragmented poor quality data, you sort of combine those two. If I could take that liberty, that's certainly a big chunk of it. And yeah, manual processes and lack of consistency, that makes sense, right? From just a data flow, a workflow perspective. So yeah. Okay, interesting. Any comments, guys, on the panel before I get into the next question on those results?
I'll start. I think it's quite telling that it's actually quite a balanced result, in the sense that there's a mix of problems around, which means this is still relatively new to us in terms of, okay, there's actually quite a lot of facets we need to think through. There isn't essentially a facet that we've already worked out ultimately. I mean, the starting point, as you said, has to be around data quality, doing an audit internally to make sure you know where everything is. But given historically we've got lots of systems, lots of manual processes, those things do need to be ironed out internally as a business before we can deploy effectively.
Yep. All right. And so Steve, you see the poll results in terms of how people feel about the barriers. From your perspective, right? What should leaders and folks within any industry, but certainly within ours, be thinking about to move forward effectively?
Yeah, I think there's three things, Jeff. First is prioritizing on focusing on the right use cases. don't try to solve everything at once. And just because you can automate something doesn't necessarily mean that you should, at least not as is. Don't automate a bad process. Most of the processes that are in place across industries today were built for humans and the constraints that carried with it. And I think that this is probably the root cause for that 40% number that you shared from McKinsey, is that we're not always picking the right use cases, and we're taking a bad process and just making it an automated bad process, which doesn't necessarily help the business. So we recommend that you target high value areas where the impact is measurable. And this will help you create early wins, build momentum, especially in environments where there are many legacy systems and broad transformation can be difficult. Let's find some quick wins. Second, I think, is fixing the data foundation and the fragmentation challenge that you saw on the slide. Most organizations are working across siloed legacy systems that weren't designed to work together. Leaders need to invest in bringing systems of record together and applying that consistent business context layer that we talked about earlier. Without that, you run into issues with accuracy, explainability, trust. All those things slow adoption. And the old adage, garbage in, garbage out, applies here, just like it did for traditional analytics. The third thing for me is building the right operating model. And this includes not just strong governance, like we've been talking about, but also addressing the skills gap that exists in basically all organizations. Your teams have to be upskilled to work alongside AI, not to be replaced by it. And the firms that move fastest are redesigning their workflows, and they're augmenting decision making while ensuring that the models are controlled, they're monitored, and they're used responsibly. So if leaders stay focused on those, I think we can move from pilots to scale business impact.
Yeah, good stuff. Charles, in terms of equipment finance, right? What do you see in terms of where organizations should focus in order to overcome these barriers as it relates to our industry?
Yeah, I think the barriers, as Steve said, is, well, first, we've been traditionally quite fragmented, right, on how our products work. There's been quite a lot of solutions there, but I think the real focus actually is quite internal first from a business standpoint. So equipment finance, right? We've got lots of different assets. We've got different deal structures, product variations, non-standard scenarios, you name it, we have it, right? Simplifying that and making sure we understand where the mass of the data is, cleaning that up is really important. We also have quite a long life cycle in terms of a financial product. You go from originating to servicing to collections, which actually means there's quite a wide breadth of use cases you can do. And it's about tackling the right scenarios and then potentially merging them together to get even more insights. But to me, the key areas of focus are, number one, everyone can do this today: audit your data, understand where it lives, how it's structured, establish common data standards, taxonomies, so definitions, consistencies within your organization. Everyone's definition of an asset or XYZ is different. You need an integration strategy, so not just thinking we need AI, but do you need a middleware? Do you have the APIs for it? Do you have interoperability? And that is where actually sometimes vendors do have better answers to help support businesses, but of course it can be done in-house if you've got the relevant skill set as well. And then the last thing is governance. So ownership, controls, long-term data integrity, look past just implementing it now, but how do we make sure then the data is still clean afterwards? How can it still be useful? It's not just a technology project. It requires really, really strong business engagement to make sure it's a success.
Okay. Yeah. Thank you, Charles. All right. So this is the last section that we want to talk about, right? And so we covered, right, is where is AI delivering value today, how it's improving not only processing speed, but mitigating risk and the whole idea of managing risk within our businesses and using the tooling for that. And then the last section there, of course, was barriers to entry and what folks either perceive or is actually holding them back, and some of the ways that we can overcome that as we go forward. So what we want to wrap with, and I think there are maybe several questions in the chat as well too. We'll get to that after we finish the section. Steve, I think as you mentioned, right, some of the things that are in production today are on the left, right? We talked about virtual assistants, credit scoring, the fraud, automated reporting, all of those sort of things. I think broadly that makes sense and they're there. the emerging and near horizon items are, I think, of what's it's most of is of most interest to us, right? The agentic AI workflows or multi-agent orchestration. I have a colleague who may be on this panel with me who likes to say that maybe we'll never need screens again when we're managing an equipment finance portfolio, because we're just chatting with or the agent is managing things, presenting us with the screen, but not our traditional screens that we think of, is just presenting us with a decision to make, approve it, and you move on, and then the next thing comes in, right? So I think we're a ways away from that, but I think it's an interesting thing to think about as we go forward. So where do you see what will the winners be saying in 3 years?
Yeah, it's right along the lines, I think, with what you're saying here. I believe that the winners will be talking about AI just as part of how the business runs. It will become almost a utility to them, using it seamlessly in every process, and things like multi-agent workflows, they'll just be commonplace. These firms will point to faster decision cycles, lower cost to serve, better risk outcomes. They'll have addressed the data issues. They'll have built teams that know how to work alongside AI. Governance will be embedded so that scaling in production feels controlled and predictable and not risky. I think the laggards will be stuck in pilot mode, like some organizations are today, and they're not going to solve the data problem, and they'll struggle to integrate their legacy systems, and they'll question the outputs that they're seeing from the AI systems. You'll hear ongoing concerns about cost and regulatory friction. Skills will be a blocker. These teams will be uncertain how to move beyond experimentation. So the real difference won't be access to technology. We all have access to the same technology. It's going to come down to execution. And the winners will treat AI as an operating model shift. And we have this term at Microsoft we call frontier firms, where that is definitely taking place already. Well, the laggards will continue to treat AI as a series of experiments that never scale.
I like that. Frontier firms. Okay, and then Charles, we think about equipment finance. There's increasing competition in our space, right? The fintechs, private credit is certainly making their presence felt. Where do you see things headed in the next 2 or 3 years?
Yep, absolutely. I think the first thing is for businesses is the key to recognize where you are in the process, right? Are you currently siloed where you've got separate systems and you're reconciling manually? Are you connected where you've got APIs and integrations linking up to certain core systems? Or are you at a point where you're unified, where you have single sources of truth across systems, real-time access to this data? Or actually, are you at the end of the journey where you're actually AI ready? So you've clean, structured, governed data, you've got processes in place, and it's enriched, ready for AI to be applied on top. You need to make sure those foundations are there for successful AI deployments, which is something we can all today, regardless of whether the AI piece is delivered internally or externally. I think there are massive gains over competitors if you can use AI to deliver things like insightful predictive models around business trends and behavior. For example, when a customer is most likely to open your email or refinance the next asset at the end of the life cycle, is something we all know we could do, but the challenge is actually executing the idea properly, which again, to a certain extent, vendors can absolutely help with, and having the data, which only businesses can do themselves. I don't think AI is about delivering something original and unprecedented that shakes up the market. It isn't like Klarna buy now or pay later, for example, or it's not like Spotify. Like Klarna would you typically imagine competes with the standard loan. It's actually about making faster decisions, better decisions, and then to a point where it's hyper personalized to the individual or business. And the magic sauce on how you interact with your customers and that judgment element is all with you, and how do you do all of that safely?
So I thank you both, Steve and Charles. And so we have a few minutes actually for questions. I unfortunately am not able to see the chat momentarily. So I don't know, Charles, if you can see them, maybe you just do we want to field a couple of the questions that are out there, or?
Yeah, I can go through them chronologically.
Sure.
So the first question from Mark is the asset management side is the only department not having a systematic solution in leasing and finance. I think that's absolutely. I'll start from from a leasing and finance side. I think that's absolutely true. I think asset management is a little unique per business, depending on how you want to classify assets. I think AI is quite useful in that regard again, because you can look at things like originally you would look at collateral value, residual risk, but with data aggregation at scale, with pricing models that are market aware, and then you're also looking at predictive modeling where you can look at more information like usage patterns, what customer segment there are, economic outlooks, and asset characteristics. While it's always constantly learning, you can also then use it to simulate the what if scenarios, right? So if there's an interest rate shock or a regulatory change or technology shocks that we've seen kind of in recent years, actually, that does shake up the market to allow you to stress test it properly at a portfolio level. Going further, I think you could also say you could do risk aggregation on a portfolio level. So instead of doing asset by asset, you do clusters, you identify concentrations, you detect correlated depreciation risks that it might not be obvious from a smaller subset, which then helps with capital allocations and provisioning decisions. I don't think it is something that is standardized, but with these insights, it can help bring a lot more data in, which can drive it towards being standardized ultimately.
Okay. Yep. Good. Thanks for that question, Mark. Are there any other? I can see it now. I'm scrolling through
Yeah,
it.
for
Obviously, some good commentary in there. In
Yeah.
terms of, sorry, Steve, did you want to take one?
Yeah, there's one at the end that I think I can take a shot at here. I know there's some others that are before it that are probably more suited for Charles, but I think it was Christopher's asking about AI as a broad term, and when we talk about AI adoption, what tools or platforms are we referring to? Are we talking about ChatGPT, Claude, et cetera? So, good point. AI is not new. AI has been around for 50 years, and we've been doing machine learning and predictive things like that for many years. What we're talking about more so now is the large language models and really their ability to reason, which is kind of the thing that's been groundbreaking over the last 4 years, and how that can change from a business process standpoint. And we now have an AI system that can take some inputs and some skills and some knowledge, and it can actually make decisions. And the AI can decide how it solves a problem. You don't have to be. It's not like building a workflow where it's step A, step B, step C. It can actually decide based on the skills and capabilities that you give it how to solve a problem. And that's what's changed. And I think that's where we're seeing the impact over the last couple of years.
Okay. Thanks, Steve.
Mhm.
Here's another one. Any concerns regarding data privacy agreements of public LLMs, or are there recommendations to leverage local AI LLMs?
I think that's a key question, firstly,
Hmm.
from a lot of the customers we've worked with. Where does the data go, right? Do we do cloud processing versus on-premise? What are the model training boundaries? And how about data residency requirements, etc.? I think the key here is a lot of vendors do work in partnership with technology companies as in AI providers, which will then segregate that out in the right data center so that the data is not being fed back to the model itself. So those agreements are in place. I can definitely speak on behalf of FIS and some other organizations in our space which already do this.
Yeah, and there's a difference between, when you're running, like, say if you go direct to OpenAI to consume GPT models, right? That they have a different data privacy agreement than you might have as a customer with Microsoft, or like FIS has with Microsoft. So
Yes.
when you're using it in our environment, right, that we're the operator, right, and the rules are bound to the agreements that we have between Microsoft and you as a customer. So um, we believe there's an advantage there in terms of privacy and compliance.
Definitely. Okay. And then maybe,
I think there was a
well,
couple earlier, maybe
yeah,
in
I
up in the
like this
front. Yeah.
one. So I think it's from Chris saying something that come back to AI amplifies whatever process you pointed at. So the prep work on standard operating procedures, controls, and data matters as much as the tech. It's a chance to redesign the model, not just speed up the current one. I think it's a great point, really. But anything you want to add maybe on that, Steve?
I think he nailed it. And it's
Yeah.
really, thinking about a process not as it exists and taking pieces of it to automate. Like think about the whole process. What would you do if there was no existing process and you were thinking about it with the full spectrum of capabilities that you have today from an AI standpoint? How would you then design that process to make that more effective?
Yep. All right, I'm scanning through I know we're getting close to time.
There's a question from Shabazz around with FIS announcing a strategic partnership to Anthropic to bring agentic AI into banking. How does FIS envision extending these AI capabilities into the asset finance product portfolio, particularly across lease and loan origination and servicing? So that's something we're exploring today internally. We are going to leverage Anthropic and the relationship there in order to develop and build our initiatives as well. So those conversations are happening as we speak.
Yeah. And then in terms of is a good one. Where curious again from Chris, I think curious where everyone lands. Are you building AI capability in-house, leaning on consultants, agencies, or running a hybrid? And obviously that's a broader question for the it's sort of amusing perhaps. But I think what I touched on earlier around having the right strategy for your deployment is so important here, right? If it's fragmented or you've got different parts of your business utilizing different vendors, et cetera. I think if you have this holistic approach to what you're doing, then this AI capability, I think it's like building the software products over time, right? Like people have always said, build versus buy. And I think it's tough to scale building your own core platform or originations platform. People have found that over the years. I think it will be also difficult to just build this all in-house. I think you're going to have to lean on partners, yes, consultants, agencies, et cetera. And yeah, it could be potentially a hybrid here. Charles, did you have an additional thought on that one?
No, I think you've hit the nail on
Yeah.
the head for that.
Okay. I saw your head nodding. That was agreement then. All right. Anything else? And let's see. Let's see. Yeah, I think again, Christopher, a good one, right? Like we don't have this. That's not the point of this conversation today. But seeing a live showcase of a use case end to end built out, be showing how this. I think absolutely. I think everyone needs to see that, right? Because there's a lot of theory going on when we talk about these things, but there are real use cases out there that can be seen where you can see end to end benefit, and you can think about the as is process of how it was manual, how you had to look in a shared inbox, or you had to do different things even in your current core platform, and then suddenly there's this automation with an agent doing it and just presenting, hey, here's the final option, right? Like this repossession is we've received everything, we have all the paperwork, everything's come in from our external agent. Do you want to process the repo? Okay, like those are the types of things that are there instead of having to do all of that legwork, pull in the file from disparate systems, the old swivel chair approach. Like they're real things that are out there. And yeah, again, wasn't that there's nothing software showcasing in this presentation, but these things are out there, and it's just really it is beneficial to start seeing what's out there.
I think there's just a few more quick questions to wrap up on, if that's all right.
Yeah. Yes. All right. Let's do the last two. So from Andrew, I haven't read this question yet. Do you predict there will be out-of-the-box task-oriented plugins or specific tasks that could be adopted across organizations, collections, asset valuations, et cetera, et cetera? You want to take that, Charles?
Yeah. So the challenge there obviously is across technology providers that would be challenging, right? But I think from what we've looked at, for example, in analytics, that's something, of course, technology providers can give. So let's say there are certain agents that provide insights on valuations or collections reports. If we pre-built it once, then we can obviously apply and deploy that across the board. So yes is the short answer. I think there are generic processes that you can get enough value out of. Identifying those use cases and then having the right agents atop will give a lot of value to end customers and businesses. And that actually kind of is the role of the vendor in the first place, right? To create enough use cases and benefits so that when you do work with a vendor, that is not just a system that is being offered, is actually on top of that, you have a lot more capability that helps you grow your business more.
Okay. I think we're at time. If there is any other additional information, website is listed. Certainly reach out to any of the panelists. Our details are public on LinkedIn, et cetera. But the point of this is just to share ideas and connect with the industry. So thank you to the Monitor for putting this on, and thank you for everyone for attending. I'll kick it back to you, Rita, if you had anything to finalize.
Just wanted to thank all of you for being here today. Thank you, Jeff, for moderating. Thank you, Steve and Charles, for all of your insights. We did put a survey in the chat. If you could complete that, that will help us as we plan future events. Thank you all for being here today, and we hope to see you on another live stream event soon.